This is Asia Trade. I'm Shery in Seoul.
I'm Avril Hong in Singapore. The top stories this hour. Traders go risk on with stocks gaining and bonds losing steam as President Trump backs a deal to end the longest ever government shutdown. The European Commission is exploring ways to force EU member states to phase out China's Huawei and ZTE from telecommunications networks. And former U.S. Deputy Secretary of State Campbell joins us with his view on how the Trump administration is reshaping America's global alliances, whether for better or worse.
You said it, Avril, we're coming off a risk-on session across Asia already. We had seen the Aussie dollar at a one-week high on expectations that government shutdown in the U.S. would end very soon. We also had the Chinese yuan gaining ground and rising across the board as China and the U.S. suspended port fees on each other, signaling more easing of trade tensions. The fact that the S&P 500 top 6,800 will be felt across Asia as well. We had already seen the Nikkei gaining ground with the Japanese yen under a little bit of pressure right now, trading at that 154 level against the U.S. dollar, as we had also heard that Prime Minister Sanae Takaichi would be expanding fiscal policy. She plans to kill an annual budget balancing goal, so we'll be watching JGBs. Potentially, of course, fiscal spending could mean more debt risk and perhaps long-term yields also continuing to be pressured towards the upside. But Avril, I'm in South Korea. We'll be watching the Kospi. We saw it gain ground in the last session, rebounding after a week of losses, the most in 8 months after a series of positive news. We're talking about a potential dividend tax cut that has been reported by South Korea media, not to mention that perhaps the National Pension Service's allocation of its funds into more domestic equities could boost the market.
Yeah, Shery, I guess to your point, in some ways, Asia really led the way on the rebound just a day ago, and we saw the Wall Street performance, investors piling into risk on the optimism that we are nearing a reopening of the U.S. government. That also meant that tech shares that, of course, have been going through a relatively rough patch, they were the ones that drove the rally. Look at this chart on your right. It shows you these chips are really driving the rally. It's taking volatility back down with it. I guess the message here is if everything is going well with AI, then most things are okay. If you take a look as well at what we're seeing in other assets, the dollar underperformed. We also saw investors selling treasury, so a trend that we're going to be keeping watch on. Now, the Fed rate cut bet seems to be coming back to the fore. Gold is holding up above the 4,100 level. So lots to keep watch on in the session today, Shery.
Yeah, especially the fact that we could potentially see the end of the longest government shutdown in the United States, right? President Trump backing a bipartisan deal to end the shutdown, a key development that makes it likely that the government reopens within days.
I think based on everything I'm hearing, they haven't changed anything, and we have support from enough Democrats, and we're going to be opening up our country. It's too bad it was closed, but we'll be opening up our country very quickly.
The U.S. Senate has resumed deliberations with another vote on the bill planned in the coming hours. Let's bring in Bloomberg senior editor Derek Wallbank. Derek, when it comes to both sides, Republicans and Democrats, were they able to save face?
Kind of. It's a really interesting sort of conclusion to what is the longest U.S. government shutdown in history, right? Democrats had gone into it really wanting to get an extension of these subsidies on Obamacare, the health care subsidies, and they're coming out of it without that. They're coming out, in fact, with a deal that they probably could have gotten a couple of weeks ago. Instead, what they're getting is an issue. If I say they lost the policy but won the issue, that might be kind of where we are. 8 Senate Democrats broke rank, and what they're getting out of it is a confirmation that the Senate will vote on the issue as a standalone. Now, there are some hopes among Democrats that Republicans, they'll be able to find enough Republicans to go along with it. That's a major thing that we're looking for. But if they don't, if Senate Republicans block that vote, or if the House refuses to take it up, then you are talking about about Democrats having a very potent issue to talk about on the campaign trail walking into a midterm election. And keep in mind, it was only last week that we saw Democrats win major elections in New York City, in New Jersey, in Virginia on that core issue, affordability.
Derek, when it comes to deal making for the U.S. president, I suppose it's also worth keeping in mind it's about these tariffs. And we're hearing that we could be nearing deals with India, Switzerland. What do we know?
That's right, Avril. And now it's very early days, and we're sort of taking Donald Trump at his word for the descriptions of these right now. But he was saying to reporters in the Oval Office just earlier today, my time, that a deal could be very close on India that could take the overall tariff rate down. Now, what that comes down to, too early to say right now. There has been some speculation that maybe it drops from 50.50 to 15.15. That would be a quite significant drop. But remember, India is paying one of the largest tariffs anywhere in its region right now, both with a 25% tariff as well as a further 25%. That's how you get up to 50 as a sort of penalty from Russia oil buys that Donald Trump wants to disincentivize. So any sort of move to take that down would be quite significant. The U.S. just swore in Sergio Gore, a longtime Trump aide, to be the new U.S. envoy to New Delhi, and so he's going to be going over now. And he was saying just today one of his biggest missions is to sort of like build on that relationship, figuring out where those trade ties are going to be, what level is sustainable there, is going to be probably the first order of business, one would think.
Derek, thanks for bringing us the latest on all this. Bloomberg senior editor Derek Wallbank. Now, air travel disruptions mounting across the U.S. as lawmakers push to end the federal government shutdown, with an air traffic controllers union warning of the erosion of safety as critical workers miss their second straight full paycheck. More than 1,600 flights were cancelled as of 12:45 p.m. New York time on Monday, and that's according to data compiled by aviation analytics firm Shery. Meantime, investors flocking to risk assets on those positive developments on Capitol Hill. Let's bring in Bloomberg MLive strategist Mark Cranfield. So maybe we're nearing the reopening of the U.S. government finally. How are traders positioning for the end of the government shutdown?
Well, they're hoping this is the Christmas rally that they've been waiting for. It was interrupted. We had a little bit of a skirmish last week. People got a bit angsty about AI and whether the valuations were right, whether the bubble was already about to burst. But now they seem to be reassured. Yesterday's move for NVIDIA, something like a 6% rally in NVIDIA yesterday on a huge, biggest stock in the world, moving up by that kind of amount, shows you that's what people want. Obviously, they just want everything out the way. Let's have a clear run into the end of the year. From what we've heard from people like Derek and others is that the vote going through the House of Representatives is not going to necessarily be as smooth as it was through the Senate. So there's still plenty of room for disappointment. That'll be later in the week. But if it does go through, you can clearly see people want to put money back into the market. They assume the rest of the earnings season is going to be very good. NVIDIA reports next week. They have a track record of posting very good outlooks. What we've recently heard from Jensen Huang suggests that this outlook is going to be very good for 2026. That's what investors want to hear. They'd like to get on with it and keep the moves going for the next few months. But it does depend on what the House of Representatives do with the shutdown.
Yeah, and investors really watching, looking to what the Fed has to say, especially given that the shutdown hasn't given us that much information about the state of the U.S. economy. And yet we're hearing a lot of Fed speak, from the St. Louis Fed president, for example, talking about how the economy could bounce early next year and how much more caution you need for these rate cuts. Take a listen.
In the past year, the real federal funds rate has declined by 250 basis points. Of that, 150 basis points have been reductions in the nominal interest rate to provide insurance to the labor market and to get ahead of any deterioration in it and to keep the labor market around full employment.
We also see a labor market that's softening and wage growth that is moderating. So you're really not going to see a lot of pressure coming on the cost side of labor. So I put those things together, and we don't want to make the mistake of holding on too long for rates, only to find out we injure the economy.
What sort of data are we going to get when we finally get the end of the government shutdown that will guide the Fed for what comes next?
far too much data for investors to be able to absorb all in one go. In a way, it's going to be a little too backward-looking to some extent. People will be more extrapolating what the effect of the shutdown is on people that lost money during that period, unable to spend, the dampening effect on the jobs market. Those things will probably be more relevant. Should the shutdown finish this week, as we're currently expecting, the next thing is probably the narrative for the Fed to lower interest rates as an increased insurance against weakness, because some people are predicting that the fourth quarter, based on the losses because of this long shutdown, the fourth quarter actually could be a negative GDP period for the United States. Now, the US administration, I'm sure, don't want to see negative growth in the fourth quarter, so they will be going all out to put pressure on the Federal Reserve to make sure they do that rate cut in December. So even though the market is not fully pricing for it, you can expect there's going to be a lot of voices telling the Federal Reserve that's what they need to do. Stephen Mirren is still calling for 50 basis points rate cut in December. Others probably looking for just a 25. It's a very split Fed. There's time to get everybody on side, and you can expect that traders will be looking for anything from Fed speakers which suggests that they're coming round to the conclusion they do need to do another interest rate cut. And that's what will help to drive the market into year end.
Bloomberg and Live Strategist Mark Cranfield there with the latest on what to expect from the markets and potentially the Federal Reserve as well. Coming up on the Asia trade, Tencent-backed startup Genspark joins to discuss trends in AI agent deployment. Former U.S. Deputy Secretary of State Kurt Campbell also weighing in on shifting trade dynamics between Beijing and Washington. Plus, we're live again at the UBS Australasia conference. We speak to their co-head of global banking, Greg Peirce, in the next hour. Much more ahead. This is Bloomberg. Bloomberg has learned that the European Commission is exploring ways to force EU member states to phase out Chinese telecommunications giants Huawei and ZTE from the region's mobile network. So let's bring in our China correspondent Min Min Lo in Hong Kong. Min Min, what's the concern here and how much enforcement power does the Commission have?
Yeah, this has been an ongoing concern for many years, right? Back in 2020, during Trump's first term in power, the European Commission already adopted this so-called 5G toolbox. It's a policy recommendation for all its members to exclude what it calls high-risk vendors, the likes of ZTE and Huawei, Chinese companies, basically, to exclude them from the region's telecommunications infrastructure. The concern is about ceding control of these critical national infrastructure to foreign companies, especially Chinese companies that are subjected to what it calls third country laws, especially when it comes to data collection and national intelligence. But now the European Commission wants to upgrade this recommendation to a rule so that countries that do not comply will have to go through an infringement procedure and face financial penalties. Now, we know that at least 10 countries have adopted some sort of restriction against Huawei and ZTE, so the take-up rate is not high considering you have 27 members there, right? This is obviously something that could escalate tension even further with China, because back when countries like Sweden, for example, had banned Huawei, China had responded forcefully. Eventually, it retaliated by restricting access to Sweden's Ericsson, for example, from the Chinese market, leading to a collapse of its market share. So that was a backlash that dissuaded some other EU countries from following suit. And it's likely to spark debate in the EU as well, because already many countries are reluctant to cede control of national security decisions to the European Commission. There are telecommunications providers who are also opposed to this, saying that Huawei is in fact a cheaper and better alternative to the European companies as well. But of course, big beneficiaries would be the likes of Nokia and Ericsson, who could benefit from a potential ban of Huawei.
Yeah, Min Min, I guess we're watching to see how Beijing potentially responds to all this. When it comes to what's been driving the Chinese stock rally, it's also about AI, it's about tech self-reliance. Across Asia, that AI theme does seem intact. We also had the likes of TSMC reporting its slowest sales growth monthly basis since February last year. How worried should investors be?
Yes, TSMC released its October numbers. It came in at 16.9% in terms of sales growth. So this is the slowest growth since February of last year, slowest in 18 months. So, of course, it is sparking a lot of debate, right? Already there has been all these concerns about whether an AI bubble is building out, whether valuations are being too frothy. But our Bloomberg intelligence analysts are saying that this is not necessarily a reflection of slowing AI demand, because there is also the factor of the dollar weakness as well. If you look at the sales numbers in dollar terms, actually it has increased by about 22%, which is aligned with the midpoint of TSMC's fourth quarter guidance. And even if it continues at the current pace in new Taiwan dollar terms at about 17% or so, it is in line with the analysts' consensus forecast for fourth quarter. Of course, we're still in early days. This is just the first month of the fourth quarter, so we'll have to see. But seems like, at least from NVIDIA's Jensen Huang's trip to TSMC over the weekend, the demand is still very, very strong for its wafers.
Min Min, thank you for that update. Bloomberg China correspondent Min Min Lo for us. Now, China's Singles Day shopping extravaganza is now in its 17th year, though shifting consumer behavior has transformed this traditional one-day sales blitz into a weeks-long campaign. Bloomberg's chief North Asia correspondent Stephen Engel with this report.
Influencer peddling is all the rage in China. Online, of course, but now more than ever before, on the actual trade fair floor as well, where rapid-fire hawking of product over multiple mobile phones direct to China's billion-plus consumers has never been this, well, in your face.
I don't know how they talk so much. Everything you would possibly need to know about Vietnamese iced tea.
And other products from overseas. Doesn't matter if it's New Zealand milk powder and ice cream or Italian cleaning supplies, complete with a Mandarin-speaking European. They're all competing for Chinese cyber shoppers in a market where around 40% of all retail sales are now done online.
A single day, 11/11 is huge. We have a strong presence on online platform, and we have a strong focus on Gen Z.
I know Singles Day had another few more weeks to go, but so far the result has been very, very encouraging.
Online shopping in China is growing at 3 times the pace of traditional retail, with many brick-and-mortar outlets feeling that pain. CPI did pick up slightly in October, but overall retail spending is expected to have slowed again as households hold on to savings amid economic uncertainty. Add to that are lingering worries importers and exporters here feel about the fragile trade truce with the United States.
High tariffs are hurting everybody, hurting both sides. One of the things that as businesses we do hope is that there is longer than a 14-month detente, shall we say, but that there is some general baseline of the relationship. These are areas we're going to trade in. These are areas that are no-go. This is kind of a gray area where we'll keep negotiating on, because that would help us all, to your point, really understand what we can move forward. And if I do want to have a 5-year contract with an American supplier, I know no matter what, I'm going to get that product.
I think it's been critically important that we have clarity.
U.S. wine exports to China this year were down 77% in the 7 months through July from a year ago, with Chinese tariffs and taxes combined amounting to about 75% on American wine. And yet Barros is cautiously optimistic for a recovery, as the truce has kept tariffs from escalating further.
It was a very, very positive development that they came up with an actual number that's going to be in place for the next 14 months, because before that, I think a lot of importers weren't so upset about the tariff. They didn't know what it was going to be. And so now we know what it's going to be, at least through the end of December of 2026. And I'm hoping that that brings some normalcy back into the process.
It's an endurance game shared in some respect by the many influencers in nearby booths, to keep talking and to keep the parties on the other end engaged. Stephen Engel, Bloomberg News, Shanghai.
We have more ahead on the Asia trade. This is Bloomberg.
South Korea's upstart new exchange Nextrade is looking to grow its list of trading products into new areas. CEO Kim Hak-soo spoke with us exclusively in Seoul.
We have had two main strengths over Korea Exchange, longer trading hours and lower fees. But both of those advantages are now at risk of disappearing in the long term. Of course, it'll take time for Korea Exchange to fully match what we offer. But over the long term, the distinctions between us and Korea Exchange are likely to disappear. That poses a serious challenge for us. Until now, we exclusively offered the pre-market and after-hours sessions, and that's helped us secure a strong foothold in the market. But going forward, it's no longer just about hours. We'll need to compete on quality.
Let's talk about new business areas. So you have started Nextrade with trading in listed equities, stocks mainly, but do you have any plans for listing or offering trading of other securities such as ETFs?
We're currently preparing to launch ETFs. Our goal is to roll them out by the first half of next year, though there's a chance the timeline could be slightly delayed.
ETF product that the Korea Exchange might be more reluctant to offer trading, you mean? Would that be like some kind of a leverage or inverse ETF?
That's right. There are plenty of such products out there. As Korea Exchange is the main regulated exchange, it naturally has to prioritize investor protection. Of course, we also have those responsibilities, but there are some differences. That means there may be products that Korea Exchange has been somewhat reluctant to handle that we could have more flexibility to offer. That's the point I was trying to make.
I have a question about the fractional investment and security token offering business. So you're one of the 3 consortium that have submitted application for the license. And how would you plan to distinguish your company, and how does this fit into Nextrade's growth plan?
As I mentioned earlier, we should not focus on competing with Korea Exchange only. We should also develop new products. And I believe those new opportunities lie in the over-the-counter market. Looking at global trends, the future of the OTC market seems to be in tokenized securities. There's already active discussion in Korea on that front, and regulatory preparations are underway, although nothing has been finalized yet. Right now, we're working in partnership with Musicow, a platform that tokenizes music-linked securities. In that sense, our focus is somewhat unique. While others in this space have centered on real estate-backed securities, we're dealing with securities based on intellectual property, especially in areas like K-culture, which has been drawing global attention lately.
Let's talk about the 15% rule, the key hurdle to the Nextrade's growth. On November 3rd, this week, Nextrade has decided to suspend trading of more stocks, including Kakao, which is hugely popular among retail investors. Why did you make such decision?
As trading activity picked up on our platform, we suddenly faced a new kind of challenge. In Korea, there's a regulation that limits alternative trading platforms' trading volume from exceeding 15% of the total trading volume of Korea Exchange. It surprised us and the regulators. So what we can do in the meantime, it was best to comply for now. That's why we reduced the number of tradable stocks on our platform from around 800. This situation undermines both the credibility and the continuity of our market. That's ultimately bad for investors. We're fully aware of that. Of course, the regulation serves a legitimate purpose, but it also has unintended side effects, and the regulators understand that as well. We're in active discussions with the regulators, and the Financial Services Commission is closely monitoring how the 15% rule is playing out. I believe they're taking a flexible stance. I can't say the rule.
Breaking data crossing the terminal out of Australia, we have Westpac consumer confidence. After 2 straight months of on-month declines, we're seeing it rising 12.8% for the month of November to 103.8, and this is the highest in 4 years, so since December 2021, and is an interesting development, of course, given the elevated cost of living pressures in Australia and uncertainty among consumers about the path of RBA rate cuts. So maybe some cause for optimism. Current conditions, we see it at 98.4, so that is a rise of 9.7% on month. Taking a look at Australian assets, we of course saw that rebound just a day ago. Commodities in general have been faring pretty well. The benchmark looks flat for the moment. Aussie dollar also cooling a little from its recent gains against the greenback. Take a look at how Nikkei futures are pointing. We are expecting perhaps some of that continued optimism, which already saw in the Monday session, to continue on and flow through this really tech-related rally driven by chip-related stocks as well, Shery.
Yeah, let's talk a little bit about that optimism around artificial intelligence, especially Genspark is an AI agent startup that focuses on customizing workflows and increasing productivity for its users as get more in their business model and growth strategy at a time when investor enthusiasm for AI, of course, is reaching new heights. Joining us now is co-founder and COO Wang Sang. Great to have you here in the Seoul studio. Tell us a little bit about your business right now, because we're hearing about these millions of dollars being raised in funding.
Absolutely, Shery. Excited to be here. And thank you. So we are a Palo Alto-based technology company. We build AI agents for knowledge workers. We believe 1 billion plus knowledge workers around the globe everybody deserves more freedom, greater freedom. So we launched our super agent suite back in April this year, and within 5 months, we've broken $50 million of ARR. And with that, we've raised, up until this February, 2 rounds of funding, $60 million of seed round and $100 million of A round. Now, we have raised more money. We're officially announcing that on November 20th in San Francisco. We're doing a big launch event at the Dr. Patch studio, and super excited. But what I could say today is LG is one of our investors now.
What's the partnership looking like there then?
So they put money into our business, and we are seeing a lot of great demand in Seoul from Korea. I was just at the AI Summit Seoul yesterday, and wow, the enthusiasm of AI adoption here in Seoul is through the roof. And we have individual users, bankers, analysts, entrepreneurs, consultants. We are also hearing a lot from household names in the corporate world wanted to adopt our super agent suite and make their day-to-day a lot easier. May it come to slides, spreadsheets, financial models, documents. We wanted to automate everything for you with our AI agents.
So what are the suite of products that you're looking at building out? What would the priorities be? I guess this would be informed by what enterprise users want to see.
Absolutely, 100%. So when we first launched, our initial version had, a few things: AI slides, AI spreadsheets, AI documents. So in the past, we human beings, we were the production engine. We had to craft our work word by word, pixel by pixel. Now with Genspark Super Agent, you don't have to do that anymore. You command your super agent, basically say, hey, research NVIDIA stock and gather me all the sentiment from Wall Street in the past 3 months. Lay it all out in a 5-page slide deck. Give me the full investment memo in consideration for buying it for, buying $10 million worth of stock, and give me the full analysis on a spreadsheet. All of these things can now be done through our super agent suite. And then we human beings, we're on the other end of it. We just tell our agent if we, are satisfied with the results, or we want, the document to be a bit more concise, or we want to see more details from the financial models. So that's where the world has come to.
So all this takes, I guess, a fair bit of investments from firms. What can you tell us about how that translates into payoffs, and when exactly can we see that?
Absolutely. So I wanted to say, when it comes to how we use our investment money, we are a product and technology company. We're not a AI research company. So we don't put money into pre-training. Our technology sits on top of 30-plus state-of-the-art models. We work with OpenAI, Anthropic, Google, and all the open-source models. And we built this model orchestration layer to call on these models to do different things within even the same task. So we, of course, pay for getting access to their APIs. But then our agent really leverages the greatest model capabilities to accomplish the real-world work. Because today we're seeing so many, let's say, chatbots in the market, right? A lot of these AI models, you can go back and forth with them. They don't do real work. They don't accomplish real things for you. They don't create real values for you. But when it comes to the Genspark Super Agent, we focus on getting the work done. So some of you may know that when we launched the company, our first product was about search. Then we came to the revelation that, when it comes to information and knowledge, it's just going to be so accessible. The future of our world is not just going to be about getting access to information. It's about, if you ask the question, why do we need information at all? Well, we wanted to get the job done. So the future of the world is going to work in a way that, AI agents would run around to get the grunt work done for us and elevate all human beings to work like a Jamie Dimon from JP Morgan. You don't see Jamie typing hard and trying to get work done. He would make a phone call and the analysts would be running around to get stuff done. That's how we wanted everybody to feel about it.
That's interesting because you're basically developing your strategy as you go, but this seems to be really buying the confidence of investors. Tencent is investing in you too?
We are announcing that on November 20th.
How much?
I can't say that right now, Shery. Sorry, but we'll share about our B round.
How big of an investor are they compared to, say, the likes of LG?
I can't even. Probably similar. Yeah. I'd say our major investors are Silicon Valley investors. So I would say more on the 20th. But we've raised a good amount of money from really great investors.
About a week to go. Just let us know. But I just wonder.
We can talk more for sure.
About when it comes to tech funding, because we're seeing such geopolitical bifurcation out there. Does that matter where you get your capital from?
Look, since day one, we're a global company. Today, we have offices in our global headquarters in Palo Alto, California, in the USA. We're a Delaware C Corp. But we do have offices in Singapore. We just opened up our office in Japan because we're seeing the demand from around the globe, and we're trying to serve, the customers around the globe. And when it comes to the corporate side of the world, we initially launched our product as just for individuals. Solopreneurs, consultants, you name it. But then coming to July timeframe, a lot of the corporate folks reached out. PE firms in Japan, investment banks from London, government agencies from UAE, from Dubai, oil gas companies from Bogota, Colombia, consumer electronics companies, telecom companies from Korea. Wow. I mean, the world has entered into this token economy.
Does it matter, for example, the difference in the language base from all of these different customers? Who are your biggest markets, and how do you adjust to not just local differences in language, but also regulations?
It absolutely matters, Shery. Now, we are seeing demand from all of these markets. And when it comes to how people access our product now, the great thing about LLMs is that language is no longer a barrier. So we are an AI native company. The moment our product was born, it serves all languages to all markets. If you're in Dubai, you're going to see Arabic words from right to left. That's how our UI is going to look like. Very different. And the great thing is this technology is scalable across all industries, all countries around the globe. So,
What about regulations?
Of course. I mean, things are done very differently in different regions. Some of the clients, they may have, needs for on-prem deployment. Now, we're a startup in the making still. So, for deployments like that, we would work with great partners like NVIDIA, like AWS, Microsoft Azure, GCP, all of these amazing cloud partners to enable deployments like that. But it is absolutely different. So since we've entered into interactions and collaborations with corporates all over the world, people care about security and privacy, right? So we've since contracted with good partners to get through the certification of SOC 2 Type 2, which is more of the kind of golden standard in North America. And, in Europe, in Asia, people care about ISO 2701, 4201. We've started the certification process for those as well. And also in Europe, GDPR. Yeah, we've started doing, yeah. So all of these things matter, 100%.
Wen-san, good to have you with us, co-founder and COO of Genspark. And of course, watch out for November 20th when he has a big announcement. Little by little, we're trying to find out what the fundings look like for this company. Coming up next, former U.S. Deputy Secretary of State and Asia Group Chairman Campbell joins us live. We'll ask about the progress and prospects for implementing the U.S.-China trade deal. This is Bloomberg.
Some other top global headlines we're following. President Trump says the U.S. is close to striking a trade deal with India that would reduce tariffs on Indian goods. Trump earlier this year placed additional tariffs on India's exports to the U.S. in part to pressure New Delhi to stop buying Russian oil. Currently, the rate on many Indian goods is 50%. Trump says Modi has pledged to wind down purchases of Russian oil and expressed optimism about trade talks.
Well, right now the tariffs are very high on India because of the Russian oil, and they've stopped doing the Russian oil. It's been reduced very substantially. Yeah, we're going to be bringing the tariffs down.
Bloomberg has learned that Switzerland is close to securing a 15% tariff on its exports to the U.S. According to people familiar with the matter, a deal may be concluded within the next 2 weeks, though nothing is finalized and talks could still fall apart. A tariff deal would be a relief for Switzerland after Washington hit it with a 39% levy in August. The Trump administration has delayed an export control rule designed to crack down on shipments to companies that are majority backed by blacklisted firms for a year. The move cements one of its key concessions from the latest U.S.-China trade truce. For companies that make tech subject to Commerce Department licensing, the move offers a welcome reprieve from a policy that posed massive compliance challenges.
The UBS Australasia conference is underway in Sydney, so let's head over to the event where Bloomberg's Paul Allen is with our next guest. Paul.
All right, thanks very much, Shery. And we're joined now by Kurt Campbell, Chairman at Strategic Advisory, the Asia Group, and of course previously served as well as the US Deputy Secretary of State. Kurt, so great to have you here today. Really pleased you could join us.
Well, it's my pleasure. It's great to see you again.
Particularly with in mind the travel difficulties as well. But I want to jump straight to the news of the day, and this is the prospect of a trade deal between the US and India. And we heard some remarks from President Trump saying, they don't love me at the moment, but they'll love me again. Given the difficulties, the tension in this relationship, do you see any lasting damage that's been done?
Well, it's a very important question. After the election last year, I would say the government that I worked with that was most confident that they could manage President Trump, given the first term successes, was India. And of course, what we've seen in recent months is really a whole-scale collapse in relations at the highest levels, lots of tension, and very little communication between President Trump and Prime Minister Modi. I think some misunderstandings about who gets nominated for a Nobel Prize and some of the issues associated with the U.S. role and what went on between the fighting between India and Pakistan earlier in the year. But let's put that aside now. It's clear that both countries want to try to rebuild relations. Each leader is sensitive about how to do that, but in the background, trade negotiators have really hammered out what I think is a very substantial trade agreement between India and the United States that will take tariffs down from almost 40% to, I think, a livable range. And you'll see substantial areas where India's markets will open to further cooperation with American tech firms, manufacturing, and the like. So I'm optimistic about this. I would simply say that the most important element of our Indo-Pacific strategy is a strong and growing relationship with India. I was very troubled that relations had fallen to such a low level. You're important question really is, will there be lasting damage? And the honest answer is probably some, but we'll just have to see how deep that is.
Well, I know it's an appealing idea to set aside the India-Pakistan conflict, but at the same time, President Trump is also trying to nurture a relationship with Pakistan, inviting an army chief to visit the White House as well. So how to balance that relationship?
Well, look, I would say almost all our strategic interests lie with India, and I think our engagement with Pakistan is substantially different and much less significant since the Cold War and the period thereafter.
But nurturing that relationship does risk alienating India, Greg.
It does, and it is also the case, and I think we just have to be honest about this, Paul. Really, it is Pakistan that is more, shall we say, effectively engaged the Trump family with a variety of engagements on cryptocurrency and resorts and the like. But still, the most important relationship for us is India. We should not just tilt towards India, we should fundamentally embrace India.
And of course, in the background is China. You know, all this geopolitical positioning has China firmly in mind. Do you see a new Cold War-style narrative beginning to emerge in South Asia?
I don't know if it's a Cold War-style narrative, but I would simply say that for U.S. strategy, a close relationship with India is absolutely essential. I think increasingly you see China's support for Pakistan, which is really of central significance, military and nuclear support, and that is a subject of real concern for Indian interlocutors. I think the real issue is this enduring relationship with Russia that causes problems with the United States. India tends to be loyal to countries that have stood with it for decades, but at the same time, I think behind the scenes, India knows and understands that this horrible conflict in Ukraine has alienated Russia from most countries across the world, and frankly, India has to be more responsible about that relationship.
I want to talk a little bit about the US-China relationship as well, because I do wonder what you make of China's pushback against the US, whether China had a stronger hand than perhaps President Trump anticipated, and has the balance of power between the two countries shifted a little?
Well, look, I will simply say this. At the beginning of the first term, Paul, no country was thrown off balance more than China. They anticipated a different electoral outcome. That's not the case for this second term. They come in with a plan. They're very strategic about how they are engaging the United States and President Trump. You'll note President Xi, senior interlocutors in China, treat President Trump with great personal respect, but at the same time, every step that the United States has taken with respect to tariffs or sanctions or any step against Chinese firms or practices, China responds immediately. And their responses tend to be highly carefully designed for specific damage or signaling for the United States. And for instance, rare magnets were a shot across our bow, making clear the vulnerabilities in key areas of technology. China is prepared to match us step for step, and it is also the case that China is stepping up in a variety of vectors, building closer relations with a number of countries. Just a few years ago, they were busy alienating countries like Australia, Japan, South Korea, and India. Now they are again on a kind of modest charm offensive, and they realize that much of what President Trump has done has been disruptive to traditional relations. They see an opportunity, they're trying to seize it. Now, hopefully, I think, relatively positive trip of President Trump to the Indo-Pacific, good stops in Japan and Malaysia and South Korea, and at least initial engagements with China were somewhat reassuring to Indo-Pacific partners, and the hope will be we'll be able to build on that into the future. But I think it is undeniable that in terms of the great game, China has made some important steps and has some advantages.
I just want to end on some of your thoughts about how supply chains have been reorganized as well, and particularly for the Bloomberg audience. What do you see this meaning in terms of capital allocation, location of manufacturing hubs, etc.?
Well, look, I will say this, Paul. There's obviously a lot of talk about, in each of the stops that the president made, first with the visit of Prime Minister Albanese to the United States, but also Malaysia, Japan, and South Korea. The president signed critical minerals deals. He's launched on a major program in the United States that will look at new investments in areas of refinement, also looking at recycling for some of these capabilities. The truth of the matter is that if you look at, the vast majority of rare earths and critical minerals, of the 90 or so that are important to industrial and technological pursuits, China has an overriding advantage and dominance, both in terms of supply and refinement. And it will take years, if not decades, for the United States and partners to match that. And so this is a vulnerability that has been built up over years, and it will take years to resolve. I'm grateful that the United States, working with Australia, has committed to attack this problem, but it will take time, resources, and substantial commitment, not just this administration, but next administrations.
Just very quickly, we've only got a few seconds left, but since you're here in Australia, I wondered if you get a score for Anthony Albanese and the way he's balancing the relationship with China, the largest trading partner, the US, such an important ally. Just a quick score and a comment.
Look, the truth is, it's hard for Australians to hear positive news. They immediately tend to dismiss it or think, someone's exaggerating. I think Prime Minister Albanese handled himself extraordinarily well in his visit to Washington. He walked that fine line. He has challenges at home in terms of a population that's skeptical of President Trump, but also a country that wants a close relationship over the trenchant with Washington. He secured AUKUS, a variety of areas of common purpose, critical minerals, technology, AI. I thought it was a very good meeting, and it keeps U.S.-Australian relations on a positive trajectory.
That's fantastic, Kurt. Thank you so much for your time.
That is, I look forward to visiting headquarters.
We'd love to have you back. That's Kurt Campbell, former U.S. Deputy Secretary of State. Shery.
And Paul Allen there, of course, at that UBS conference in Sydney, with more conversations to come on the Asia trade. This is Bloomberg. And breaking out of Japan, the current account surplus coming in higher than expected at 4.5 trillion yen, a gain of more than 190% year on year. The trade surplus also beating expectations, more than 230 billion yen. The market opens are next. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens. We could see another risk-on session across Asia. Of course, we had markets rallying on expectations that the U.S. government shutdown would end, and President Trump now signaling support for that bipartisan deal to end the longest shutdown on record.
Yeah, and once we see the end of that shutdown, the focus is going to shift to the data coming through. Give us more clues on the U.S. economy ahead of the next Fed meeting, Shery.
Yeah, where the Fed goes is really so important for the rest of the Asian markets, right? So that government shutdown has really affected expectations when it comes to investors on what monetary policy would look like in the U.S. and what that could mean for Asian central banks as well. Take a look at how the Nikkei is opening, because we have had a very positive earnings season. More than half of the TOPIX companies that have reported quarterly earnings beating average analyst estimates. The yen weakened in the overnight session on that risk-off sentiment. We're seeing it at that 154 level. And do keep an eye on JGBs because we have a 30-year bond auction at a time when we're also expecting a bigger budget and fiscal spending coming from Prime Minister Sanae Takaichi, who signaled the killing of an annual budget balancing goal. What that means for long-term borrowing and long-term yields, of course, is a key question. We had the Japan September trade surplus also surprising to the upside. In fact, when it comes to those export numbers in South Korea, breaking right now for the first 10 days of November, exports rising 6.4% year-on-year, imports also rising 8.2%. We have seen a risk-on rally in the previous session after 6 sessions of losses already, and it's been a lot about the expectation of the U.S. government shutdown ending, not to mention idiosyncratic news media here in South Korea reporting that a dividend tax cut may be on the way, also that the National Pension Service could change its allocation to focus more on domestic equity. So we had more foreign buying as well of stocks, Avril.
Yeah, Shery, you said it. I mean, we look like we are moving closer to the reopening of the U.S. government, so that risk on has been quite pronounced, and we saw investors moving away from treasuries, and the dollar also underperformed. What was interesting also, if you look at the front end of the curve, we are seeing that selling a bit more than the 10 years or a bit further out, where they're still catching a bit. So maybe there is still that bit of caution there. But it's also worth highlighting overall that the bets still seem for next year to be lowering of rates. That seems to be the downward pressure that is intact on Treasury yields. Now, we also have this Fed rate cut trajectory raising the focus again, and that seems to be what's spurring this resurgence we're seeing in the precious metal. Gold is holding out above the 4,100 level, and all this against the backdrop of Fed speakers talking about perhaps the need for more rate cuts. We also heard from the likes of San Francisco Fed President Mary Daly. Take a listen.
We also see a labor market that's softening and wage growth that is moderating. So you're really not going to see a lot of pressure coming on the cost side of labor. So I put those things together, and we don't want to make the mistake of holding on too long for rates, only to find out we injure the economy.
Let's get more on the outlook for markets. Joining us now is Dayeon Hong, multi-asset portfolio manager at Shinhan Asset Management. Dayeon, always great to have you with us. I mean, I talked about the risk on sentiment rebounding, especially across South Korea. I mentioned 6 sessions of losses. I was wrong. I meant to say the worst week in about 8 months or so, a bit of that tech sell-off really hitting the South Korea market. Are these concerns about an AI bubble overblown, and where does the Kospi and the rest of those tech-dependent markets go from here?
We've seen overnight U.S. equity market move quite strongly, especially in the semiconductor industry. And so I don't think it's, I still think it's a bit early to talk about bubbles. If you look at Korea in particular and look at SK Hynix and Samsung, we are seeing shortage in memory chips, and that's the supply side issue. And so the price of semiconductors will probably continue to rise in coming months. And so there is a room for the further rally, I think, in Kospi, led by the tech sector as well. So it really depends on how the tone is set in the US, and that it will be followed in the Korean market. And today, I think we'll see further rally.
And when you talk about supply and demand, that reminds me about the bond space as well, because I just mentioned how we're watching JGBs on more fiscal spending, but we've had a crazy few sessions here in South Korea as well.
Yeah, we've seen a sharp hike in yields in the bond market in the past few weeks, and that's really led by 2 things. I think one is fading away of the expectation of the BOK cut in November MPC meeting, and that's understandable. We've seen growth pick up quite substantially in the past few months. But the issue really is down to the bond supply in the Korean bond market. And we've seen a bank debenture issuance rise quite sharply. And that was driven by the risk-on rally that we talked about. A lot of people are moving their funds away from deposits into the equity market. So the banks are losing their deposits, and they're forced forced to issue more bonds. And as the year-end approaches, typically is a seasonality that there's more bond redemptions, and so they're forced to issue more, and there's a limited demand on the buying side as the trading desks, for example, securities houses, towards the year end, they close their books, and they already limit quite a bit of the losses, the loss limits in their trading books. And so I think there's a limited demand where there's increase in supply in the bond market, and that is really causing the bond yields to rise.
Dayeon, wondering as well, I mean, amid all this, even with the risk on we're seeing today, it's interesting how the Korean won still looks relatively weak. And this is even after it's already inked this investment deal with the US. Is that a worrying sign to you?
I think in the past few weeks, or even month or so, the Korean won was really moved by Korea-specific issues. The investment deal that you talked about, and also we've seen a huge sell-off by foreigners in the Korean stock market. But I think in the coming weeks, the Korean won against dollar will be more in line with the broader dollar index. And I expect the U.S., as we see the data flows come out as the government shutdown ends, we'll probably see a weakness in the labor market data, and that will lead to dollar weakness. And so I see a tactical opportunity in dollar won for a downside movement, but in a medium-term view, we continuously see domestic investors purchasing U.S. stocks. So last particular month, in the month of October, we've seen more than 6 billion outflows from retail investors in Korea buying overseas bonds. So that kind of trend will continue, but at least until the year end, I see a tactical opportunity for Korean won to strengthen against US dollar.
I'm glad you raised that element of how retail investors are buying overseas bonds. But what about what retail investors are doing for stocks in South Korea in terms of supporting the market at a time where perhaps foreign investments have petered out a little bit? What are you seeing in terms of flows, and what is needed to drive the next leg higher in Korean stocks?
I think retail investors have been quite, short. They have short-term mindset. So when we see stocks rally, we see retail investors sell, and when there's a drop in the stock market, we see retail investors buy. But I think in the bigger picture, I think the more inflows that could come into the domestic stock market is possibly from the pension funds. Also, MPS had mentioned there is a possibility that they use tactical asset allocation to increase the domestic exposure in their equity portfolio. So that kind of sizable investment from the institutional investors will really matter for the next leg up in the South Korean equity market.
When it comes to the broader Asian benchmarks, what will be the key catalyst in the next few weeks? Because, of course, we're headed towards the holiday season. The U.S. government shutdown might end, and we're seeing these concerns around the tech rally as well.
I think there is definitely a demand to take some profit. We did as well. We've been long AI-themed stocks, but as the year-end approaches, we, as asset managers, we get, our performance is on an annual basis. And so there is a demand to take some of that profit off. And I think some of the selling that we have seen by the foreigners is also related to that. So, I think there will be some initiatives to book that profit. But if you look at more medium term looking into next year, I think the rally is still expected.
Dayeon, thank you so much for your analysis. Good to chat as always. Dayeon Hong is multi-asset portfolio manager at Shinhan Asset Management. Now, as as we've been seeing, pretty much underpinning the risk-on moves in the Asia Pacific is the potential for the end for this U.S. government shutdown. You're looking at live pictures out of Capitol Hill. The U.S. Senate has resumed deliberations with another vote on the bill planned in the coming hours. Our Washington Deputy Bureau Chief Laura Davison joins us now. So, Laura, a lot of optimism. We can finally see the pieces of the puzzle moving in place for an end to the longest ever government shutdown. What do we need to see procedurally?
Yes, so the Senate is doing a series of votes right now in the next several hours, probably between 10 and midnight U.S. time. They will pass this vote, pass this bill. They will then send it to the House. The House has been out of session since mid-September. They, once this bill passes, will have 36 hours to get back to Washington. So we expect sometime around midday, the House could resume and then pick up this bill for a vote. There is a little bit of uncertainty about exactly the coalition of House members that will come to pass this bill. Democrats have said that they're not going to support it. Republicans hold a narrow majority in the chamber, so they can do it without Democratic votes, but they really need to stick together. And there's a faction of ultra-conservative House Republicans who frequently do not vote for spending bills. So we are closely watching, all of the machinations there. Once the House does pass this bill, it will have to go to Trump's desk for his signature. So we're looking, Wednesday at the earliest, perhaps several more days to get this bill passed to officially end the shutdown.
Laura, who won the shutdown? Was it the Democrats or the Republicans in this standoff?
Democrats ended up losing here. They really are the ones who they put up the fight to try to get a vote on these Affordable Care Act subsidies for low-income Americans as they buy health insurance. They did not get that. All they got was a promise of a vote, but no guaranteed outcome. So Republicans really held the line. They stuck together, and it was Democrats who had to concede in this fight.
So talk to us about once all these things come in place, how soon we'll see the government reopening and how soon data will actually come through. Of course, this is a key thing for investors.
Yes, this is a big unknown at the moment. We expect that, within about a day of this bill being signed, the government will be back up and running. But a lot of the functions of government will take a lot longer. We are waiting to hear from the key data providers at the Labor Department, Commerce Department, when some of these reports will start coming out. There could be significant delays of, perhaps weeks because they have to go out and collect a bunch of data that they were not doing for the, 41 now days that the government has been shut down.
Laura, how's the American public feeling after all of these flight delays, food aid delays, but also at the same time, of course, a rally when it comes to tech and anything AI?
Yeah, the American public is really not happy with the shutdown. We did see that they are still blaming Republicans more so than Democrats, but no one is really coming out a winner. It's really these flight delays, as well as some of the food delays and federal workers who weren't getting paid throughout this entire process that really sort of forced the end of the shutdown to come to a close here. Particularly with air traffic delays, there have just been, a rising number. There were 10,000 flights over the weekend that were either delayed or canceled, stranding passengers at a lot of major hubs. With the Thanksgiving holiday coming up here in just a couple weeks in the U.S., there was a real desire to not have everyone's holiday ruined because the flight system just didn't work.
Washington Deputy Bureau Chief Laura Davison there with the latest on the ongoing U.S. government shutdown that could potentially end very soon. Of course, the Senate continues to deliberate. We might get a vote very soon on that bipartisan deal. President Trump has already expressed support. Back in 2013, during that shutdown, the September employment report was the first to hit the wires. That's what investors will be watching. Could be within 3 business days of reopening, according to history. This is Bloomberg. Bloomberg has learned that the European Commission is exploring ways to force EU member states to phase out Chinese telecommunications giants Huawei and ZTE from the region's mobile networks. Let's bring in our China correspondent, Min Min Lo. So what exactly is the concern here, Min Min, and how much enforcement power does the Commission have?
Well, the concern obviously is on national security and data security. This is an ongoing concern. Back during Trump's first term in power, that was when the European Commission first came up with this 5G toolbox, a set of policy recommendations to exclude some of these Chinese telecommunications companies from EU's mobile networks. And that was a policy recommendation at that time. Now, about 10 out of the 27 member countries have adopted some level of restrictions, but the European Commission wants to upgrade that recommendation to a law so that countries that don't comply will have to face some sort of infringement procedure and financial penalties. Now, obviously, this is something that China would be greatly upset by. Back in 2020, when countries like Sweden had pushed back, had imposed the ban on Huawei, for example, China had made a lot of verbal warnings, a warning to retaliate against Sweden's Ericsson, for example. There was never a formal ban of Ericsson in China, but after that, we saw a big market share decline for companies like Ericsson. And FT also reporting that China now requires companies like Nokia as well to go through a so-called black box national security review, something that could take months and could put these companies at a disadvantage compared to Chinese firms. Of course, this is part of China's plan to also de-risk and boost its self-reliance. So both sides, both the China and the EU, have concerns around using each other's telecommunications companies to build up their domestic critical infrastructure networks. So something to continue watching as this continues to develop.
Continued national security concerns, as you say, but also about tech and how it continues to drive the AI rally. What are we seeing in terms of some of the other players in the Greater China region, particularly from the likes of TSMC?
Yes, TSMC just reported its slowest growth when it comes to monthly revenue in October, about 16.9% increase. That's the slowest since February of 2024, and that's sparking speculation about whether or not, again, that valuation of these tech companies like like TSMC, SK Hynix, are they being too frothy at the moment? But we did have NVIDIA's Jensen Huang over the weekend visiting TSMC, attending the sports day there, and saying that he still needs more wafers from TSMC. And TSMC did acknowledge that their capacity is tight. And remember, this is a company that supplies to many major companies, right? Not just NVIDIA, but also Apple, Qualcomm, and the like. And they are trying to do their best to meet those demands. So our Bloomberg intelligence analysts are saying that this is not something to worry about just yet, because you've got to also think about the dollar weakness as well. That had affected the revenue when it is priced in New Taiwan dollar. If you look at the revenue numbers in dollar terms, that came up to about 22% increase in October, which is about aligned with the midpoint of the fourth quarter guidance from TSMC.
Min Min, thanks so much. Bloomberg China correspondent Min Min Lo for us. Now, some other top global headlines we're following. President Trump says the U.S. is close to striking a trade deal with India that would reduce tariffs on Indian goods. Trump earlier this year placed additional tariffs on India's exports to the U.S., in part to pressure New Delhi to stop buying Russian oil. The current rate on many Indian goods is 50%. Trump says Modi has pledged to wind down purchases of Russian oil and expressed optimism about trade talks.
Well, right now the tariffs are very high on India because of the Russian oil, and they've stopped doing the Russian oil. It's been reduced very substantially. Yeah, we're going to be bringing the tariffs down.
Bloomberg has learned that Switzerland is close to securing a 15% tariff on its exports to the U.S. According to people familiar with the matter, a deal may be concluded within the next 2 weeks, but nothing is finalized and the talks could still fall apart. The tariff deal would be a relief for Switzerland after Washington hit it with a 39% levy in August. The Trump administration has delayed an export control rule designed to crack down on shipments to companies that are majority backed by blacklisted firms for a year. The move cements one of its key concessions from the latest U.S.-China trade truce. For companies that make tech subject to Commerce Department licensing, the move offers a welcome reprieve from a policy that posed massive compliance challenges. We have more ahead on the Asia trade. This is Bloomberg.
In the past year, the real federal funds rate has declined by 250 basis points. Of that, 150 basis points have been reductions in the nominal interest rate to provide insurance to the labor market and to get ahead of any deterioration in it and to keep the labor market around full employment.
St. Louis Fed President Alberto Musolem on the labor market as we're expecting to get more data out of the U.S. with that longest ever government shutdown expected to end very soon in Congress with that President Trump approving the deal. But we had seen, of course, treasuries under pressure, the market also contending with auctions totaling $125 billion. And just FYI, the bond market will be closed Tuesday for Veterans Day. Nobel laureate Paul Krugman also saying that the U.S. currently has the worst consumer sentiment on record and the government shutdown hasn't helped. Speaking to Bloomberg, he also shares his outlook on the country's labor market.
Basically, we have the worst consumer sentiment about current economic conditions basically ever. Worse than, not just worse than the, 2022 when we had 9% inflation, but
right.
Worse than the aftermath of the financial crisis, worse than the stagflation of 1980. People are really, really down on this economy, and I have to say I don't think that the way this drama has been playing out is going to change that. If anything, we're likely to see, I was just hearing the tail end of what you're saying, ordinary people. People who are not in on the stock market are hurting and feeling extremely stressed.
Well, Paul, it's interesting that, coming out of this shutdown, one of the consequences is that we're going to get economic data figures to actually put some numbers to this economy's performance. But you think about some of the reports that have been delayed, at least 2 employment reports, CPI, PCE as well. It's unlikely that the BLS has been able to collect and actually process the data for some of these reports. And with that in mind, I wonder, what kind of quality we can expect in terms of trying to put some context around these vibes.
Yeah, we're going to have a ghost month. It appears that on labor market data, there will simply be a month that we know, anything could have happened in there. The BLS will never be able to catch up on that lost data. And we do worry a lot. I mean, there's been a problem with declining response rates and understaffed BLS even before. So the data quality is going to be a real issue. And, we're all looking at the soft data, the private surveys, none of which says that the economy is falling off a cliff, but a lot of which is at least a little bit alarming. And I'm particularly struck. I've been looking at Conference Board on are jobs plentiful or are they hard to get? And that number has fallen off a cliff. People feel really, really bad about job prospects right now in ways that the BLS numbers weren't showing before, but does suggest a kind of frozen labor market in which people, if you're new to if you're young, just getting in, or if you've been laid off, it's a really tough world out there. So this is going to be, it doesn't look like September 2008 with everything falling off a cliff, but it does kind of feel like this is starting to feel like a tough economy. And as I said, ordinary people are extremely pessimistic about the state of affairs.
Nobel laureate Paul Krugman. We have more ahead on the Asia trade. This is Bloomberg. As we continue watching developments that could bring us closer to the reopening of the U.S. government and how traders are pricing all of that in, what's been really interesting is the focus has shifted towards the Fed's rate cutting trajectory and the precious metal is a beneficiary, I guess, of that bet. Take a look at how gold has been faring in the past two sessions. It is well above the 41.20 handle, and bringing along with that the gold ETFs as well as some of the Australian gold miners, including Japanese related ones in the session today. Now, as we watch this trend unfold, it's also been interesting to keep tabs on how gold is perhaps being seen, of course, as a traditional hedge for inflation. But what's really interesting recently is how these surging bullion prices in China, they seem to be having the opposite effect. So providing some respite from deflationary pressures, which is a really interesting dynamic that seems to be emerging. And don't forget, this is against the backdrop of over the weekend, we got those core CPI numbers out of China looking really buoyant, Shery.
And really interesting you talk about that rally in gold. We're also watching the rally in tech in China, getting really crowded, raising volatility and limiting diversification for global investors. Let's bring in Bloomberg's Winnie Su to go over the top stocks and what they mean. So, Winnie, how bad is the concentration right now in tech?
Yeah, I think it is that increasing risk with tech concentration that we're seeing in the region. And just now we were talking about China. So just as numbers to highlight to you, we're talking about, for example, the Chinex index, which is a gauge for the innovative companies in China. The top 5 companies, their gains contribute to more than 50% of the gains of these gauges over the past 6 months. And that is really highlighting how it's becoming increasingly crowded with these tech names. And also we've got local brokerages talking about that level has reached to extreme levels with mutual funds in China. Their exposure to domestic tech names have reached about 40%, and there is highly likely to be a risk of rotation later this year from the more crowded tech stocks into the less crowded spaces.
Winnie, that sounds an awful lot like the dynamic we have in the U.S. stock market. What does this mean for potential for volatility?
Yeah, so we have been talking about the tech concentration risk in the U.S. for a long time already, but we are really seeing that reflected in the Asian markets, especially this year, and especially, for example, last week when you saw these volatile moves in Asia stocks, pretty much triggered by the tech sell-off after that big rally. So the volatility is likely to stay because of partly because of this tech concentration. We are talking about, for example, TSMC accounting for more than 40% of the weighting of the Taiwanese TAIEX, and also Samsung and SK Hynix combined together contributing to about 30% for the Kospi. And now we also have fund traders talking to us last week during the very volatile week, saying that the top 5 companies of the Nikkei 225 contribute to over 30% of the gauge, which means that any big sell-off in these tech companies are likely to have a broader impact for these indexes in Asia. So likely going to see a bit more volatile and more risk in Asian stocks because of this increasing concentration risk in tech companies in the region.
Bloomberg's Asia Equities reporter Winnie Su there with the latest on those high-flying tech stocks across Asia. As we continue to watch Japan as well, tech stocks, not surprising, one of the winners in today's session as well. And of course, this coming at a time when we do have SoftBank now reporting earnings later today. The expectation is for total second quarter investment gains to set to top $6 billion. So we could see a third consecutive quarter of strong returns at a time when SoftBank's market cap has surpassed that of Mitsubishi UFJ Financial Group to become the country's second largest listed companies. We also had data today showing the trade surplus for September beat to the upside. We're hearing about more fiscal spending to come from Japan. We're watching those JGB yields with the 30-year auction as well, and that fiscal risk, of course, the potential to drive up long-term yields as well. Not to mention earnings season, as I mentioned, SoftBank coming up, but more than half of the TOPIX companies have already announced quarterly earnings that beat estimates, with almost 60% reporting upside surprises. Let's bring in Bloomberg Japan stocks reporter Alice French. Alice, so it looks like it could be another day of stock gains across the board. What's driving the optimism right now?
Yes, hi, morning. I mean, of course, these kind of hopes that the US shutdown may be coming to an end soon is kind of driving that sort of relief, I think, today, and that's feeding through into Japan too. We did have some comments from Prime Minister Takaichi yesterday about her plans for these sort of stimulatory policies that she's planning into key industries that do include tech and chips. That seems to be helping sentiment too. But as you mentioned, it's all about earnings. We have SoftBank coming out today. We have Sony coming out today during the trading time. Both of those, it seems like analysts are expecting something positive to come out of that, which is only going to drive this kind of bullishness further. We know SoftBank is already up over 140% so far this year, and this is basically all around AI, right? I mean, as Winnie was mentioning before, there is a lot of excitement around AI. There is a lot of concentration around these tech stocks, and so I do think a lot of investors are kind of feeling like it's sort of become this kind of show me the money period, right? Where we need companies to actually come out and say, okay, all of this AI investment is actually helping our bottom lines. And I think that SoftBank will be a major test of that just because of how huge it's become, as you were saying.
So maybe SoftBank and Sony show investors the money, but what other sectors are you watching out for?
Yeah, I mean, of course, when we talk about AI, we're not just talking about things like chips. Like robotics companies, for example, have been doing pretty well. We saw Yaskawa Electric beating expectations earlier in the season. And then there's other things like defense. So, for example, we can see Japan Steelworks up pretty decently today. And this is also around, these kind of excitement for more spending by the government going into that defense sector under Takaichi. At the same time, things like IP stocks. So gaming, of course, I mentioned Sony coming today. We're expecting big numbers from their Demon Slayer movie. We know that Nintendo already hiked its sales target for the Switch too. So those kind of gaming and IP stocks, there's a lot of excitement around that. There are some worries of a bubble. And so again, I think expectations are going to be high, and it'll be interesting to watch that. I think that sector will be kind of a test for the overall mood in the Japanese market and just how much higher stocks can really go.
You talk about Takaichi and her spending plan. I guess that is part of the factors that is keeping the yen relatively weak, still hovering at around 154 against the greenback. What does that mean for stocks?
Yeah, I mean, look, I think we traditionally take the view that, a weak yen is good for exporters, it's good for equities, and certainly we seem to have seen some of that tailwind coming through. Having said that, in the last kind of weeks and months, we have seen the relationship between the yen and the broader Topix index actually becoming weaker. So it seems like stocks are getting less of a boost from the weak yen than they used to. Now, that's partly because of so many other factors going on in the background. AI, of course, tariffs and things like that. Now, we know that we obviously do have a BOJ policy meeting coming up right at the end of the year. Of course, the outcome of that is likely to impact the yen and will have a knock-on effect on equities. But it does seem like most people are expecting, this weak yen trend to continue through the end of the year. And a lot of companies coming out in their earnings have been saying that, the yen has been weaker than they were expecting at the beginning of 2025. And that seems to have been acting as a boost for them. So overall, it seems like the sentiment around FX and its impact on equities is pretty positive, but like I say, there are potential things that could come in and kind of derail that. So we'll have to watch as we go towards year end. But yeah, at the moment it does look sticky beyond that 150 point.
Bloomberg Japan stocks reporter Alice French there. And take a look at how South Korean assets are trading at the moment. We saw, of course, a week of losses, the worst in 8 months, actually, and we're seeing a rebound in today's session. We also saw gains for the Monday session. The Korean won strengthening for the first time in 6 days, although today under a little bit of pressure against the greenback. We had idiosyncratic news, media reports on a dividend tax cut, the National Pension Service possibly increasing their domestic equity allocation, and we are seeing also some portfolio rebalancing, especially by foreign investors, with SK Hynix seeing a sharp sell-off in foreign holdings, while Samsung tracks similar inflows. So we're seeing a little bit of a change in composition when it comes to those attractive bets when it comes to the semiconductor space. But South Korea's upstart exchange Nextrade also looking to grow its list of trading products into new areas. CEO Kim Hak-soo spoke with us exclusively in Seoul.
We have had two main strengths over Korea Exchange, longer trading hours and lower fees. But both of those advantages are now at risk of disappearing in the long term. Of course, it'll take time for Korea Exchange to fully match what we offer. But over the long term, the distinctions between us and Korea Exchange are likely to disappear. That poses a serious challenge for us. Until now, we exclusively offered the pre-market and after-hours sessions, and that's helped us secure a strong foothold in the market. But going forward, it's no longer just about hours. We'll need to compete on quality.
Let's talk about new business areas. So you have started Nextrade with trading in listed equities, stocks mainly, but do you have any plans for listing or offering trading of other securities such as ETFs?
We're currently preparing to launch ETFs. Our goal is to roll them out by the first half of next year, though there's a chance the timeline could be slightly delayed.
ETF product that the Korea Exchange might be more reluctant to offer trading, you mean? Would that be like some kind of a leverage or inverse ETF?
That's right. There are plenty of such products out there. As Korea Exchange is the main regulated exchange, it naturally has to prioritize investor protection. Of course, we also have those responsibilities, but there are some differences. That means there may be products that Korea Exchange has been somewhat reluctant to handle that we could have more flexibility to offer. That's the point I was trying to make.
I have a question about the fractional investment and security token offering business. So you're one of the 3 consortium that have submitted application for the license. And how would you plan to distinguish your company, and how does this fit into Nextrade's growth plan?
As I mentioned earlier, we should not focus on competing with Korea Exchange only. We should also develop new products. And I believe those new opportunities lie in the over-the-counter market. Looking at global trends, the future of the OTC market seems to be in tokenized securities. There's already active discussion in Korea on that front, and regulatory preparations are underway, although nothing has been finalized yet. Right now, we're working in partnership with Musicow, a platform that tokenizes music-linked securities. In that sense, our focus is somewhat unique. While others in this space have centered on real estate-backed securities, we're dealing with securities based on intellectual property, especially in areas like K-culture, which has been drawing global attention lately.
Let's talk about the 15% rule, the key hurdle to the Nextrade's growth. On November 3rd, this week, Nextrade has decided to suspend trading of more stocks, including Kakao, which is hugely popular among retail investors. Why did you make such decision?
As trading activity picked up on our platform, we suddenly faced a new kind of challenge. In Korea, there's a regulation that limits alternative trading platforms' trading volume from exceeding 15% of the total trading volume of Korea Exchange. It surprised us and the regulators. So what we can do in the meantime, it was best to comply for now. That's why we reduced the number of tradable stocks on our platform from around 800. This situation undermines both the credibility and the continuity of our market. That's ultimately bad for investors. We're fully aware of that. Of course, the regulation serves a legitimate purpose, but it also has unintended side effects, and the regulators understand that as well. We're in active discussions with the regulators, and the Financial Services Commission is closely monitoring how the 15% rule is playing out. I believe they're taking a flexible stance. I can't say the rule will change overnight, but in the longer term, I do expect to see some changes.
Nextrade CEO Kim Hak-soo speaking exclusively with Bloomberg's Yoo Kyung-lee. More ahead on the Asia trade. This is Bloomberg. Take a look at how Aussie assets are faring, because it does seem like more optimism towards the economy is creeping back in. In the past hour, we showed you how consumer confidence is soaring there. And now we're hearing how business conditions have risen to the highest since March last year. This is according to an NAB survey. We're seeing it looking pretty flat on the ASX 200, though. Gold miners are surging ahead, but that's being offset by declines in the lenders. Now, the UBS Australian Asia conference is underway in Sydney. So let's get back to the event where Bloomberg's Paul Allen is with our next guest. Paul?
That's right. Thanks, Avril. We're joined now by Greg Peirce, global co-head of banking, or co-head of global banking at UBS. He's also co-head of the bank's business in Australia and New Zealand. And Greg, I just want to pick up on a point that Avril was making there about the really good consumer confidence numbers we just had, highest in November. Really echoes what we heard from some of the three of the four big banks last week: Westpac, National Australia, ANZ. They're all sounding variously upbeat about credit quality, business confidence, the consumer sector as well. So is that the way you would characterise the Australian economy at the moment? How do you see things?
From an economic perspective, yes, it's been a bit mixed through the course of the year, but we've actually seen, if anything, a little bit of a pickup in some of the sentiment and forward projections in recent times. And look, that's playing into a lot of the deal-making activity that we are starting to see. You've got a situation where the interest rates have been broadly stable, somewhere between that 4 and 4.5% on a 10-year basis over the best part of the last year or so. And frankly, credit spreads have come in a little bit, which means that the debt financing is available for people. So we're seeing, on the one hand, from your funding side of things, debt is actually readily available and reasonably priced. On the other side, you've got the equity capital markets, which are trading a few points above their historical averages. So people's share prices are likewise in reasonably good positions. And you've seen the indices generally tick up through the course of the year. So that's all giving people a reasonably high degree of confidence. And the economic situation, which you've mentioned, is relatively stable. You know, you've got unemployment, which is still in the low 4s. You've got the consumer starting to spend a little bit again, and because people have got that higher wealth feeling, they're actually going out and driving the economy in that regard.
Well, one of the other things that we've seen, though, is sticky inflation also, and we got some commentary from the RBA suggesting, well, perhaps the easing cycle is done. Perhaps the next move could be up. So with that in mind, how do you see that impacting deal making in the future, in the coming months?
Look, I think that it's as long as it's not sharp moves, deal making will be just fine. Deal making tends to get clogged up a little bit when things are either rapidly increasing or rapidly decreasing, and people are starting to wait to see what happens and see how things play out. There's been a few moves from the RBA downwards, obviously, but it hasn't been dramatic. And so we've seen a period of relative stability. And probably what's more important for deal making is that long-term rate hasn't moved very much. And so the interest rate environment, whether or not it's one move down, flat, the next move even potentially being up a little bit, as long as it's not dramatic moves, it'll be absolutely fine for deal making.
Well, you recently took over that co-head Australia-New Zealand role not that long ago. So when you're looking ahead to the coming year, what are your priorities?
Look, I think our priorities are always very similar in terms of really staying close to the client base, making sure we're sitting there as they're in that trusted advisor position, as well as making sure that we're providing all of the products and services that are important to the client base here. So we obviously have a very significant investment bank that sits there. Post the combination with Credit Suisse, we now have a very impressive wealth management business, and there's real synergy between the two of those, which we'll be looking to take advantage of and make sure we're bringing the best of both of those worlds to the client base.
Let's talk a little bit about wealth management as well, because that's started to gain the attention of local and global investors here in Australia. So can you tell us a little bit about your targets in that area?
Look, we've got a range of target clients across that business. Anything from your mid-level wealthy up to obviously your ultra-high net worth individuals. And again, as part of the combination with Credit Suisse, we now have an enormous suite of products that exists globally, and a great group of people that we've got here locally that can service the local client base. So it's really making sure that the local client base is having all of the best of UBS being brought to them, whether or not that's global product, local product, or indeed some of the services that come across the investment bank.
One of the themes that I see just walking around the floor here at the UBS conference is AI, and just over there I saw somebody losing a game of chess to a robot. Can you tell us how you're working AI into your business, where you see this heading?
Yeah, look, it's going to have a profound impact on us as a professional services firm. You know, there's huge benefits that we see in relation to some of the processes that we undertake, some of the back office functionality, etc. And we're already developing some agentic solutions in relation to that. And so there'll be quite significant productivity and efficiency type benefits. But there's also going to be insights that we can glean by better utilising our existing data and coming up with new ideas and new product and offerings that we can put to the client base. So ensuring that we have the entire business utilising the artificial intelligence opportunities that we have, changing the way that we do business, because again, for many professional services businesses, it hasn't changed a lot in 2 decades, and it's about to quite substantially. And so we really try to make sure that we're at the forefront of driving that within our own business, and then also on the client side, making sure that we are providing the sort of other products and services that we provide, because there's a huge amount of capital to be raised to facilitate this development, and that's a core part of what we want to be doing as well.
All right, Greg, thanks so much for joining us. That is Greg Peirce. He's co-head of global banking at UBS. Shery.
And Paul Allen with those conversations joining us from Sydney. We do have more on Australia ahead as well. Every Tuesday, 11:40 a.m. if you're watching in Sydney, 8:40 a.m. in Hong Kong. And you can tune in to the Bloomberg Australia podcast, which delves into the biggest stories shaping the country's rolling global business. Find it on Apple, Spotify, or Bloomberg.com. More ahead on the Asia Trade. To keep an eye on surging bullion prices in China, providing temporary relief from deflationary pressures. China's core inflation last month seeing its fastest increase in almost 2 years. Estimates show gold prices contributed to around half of the jump, Avril.
Yeah, and this jump in gold prices, partially in the past 2 sessions, to do with the optimism towards the end of the U.S. government shutdown. That is supporting for another day Asia stocks. Chip plays, they're leading the way in South Korea. This is how futures are pointing for the open in the Greater China regions. We'll track the open of trade next. This is Bloomberg.